I just want to welcome everyone. My name is Travis Jeffries. I'm a transactional real estate attorney at Cox Castle Nicholson.
Hi.
So thank you so much for coming. I'm very excited for today's panel and to hear important capital market updates from subject matter experts. But in the meantime, I wanted to mention a few things about the Century City Chamber of Commerce. Today's event is brought to you by the Business, Entertainment, and Law Council, and I'm the co-chair of that event, actually that council. And one of the reasons why I enjoy it, in addition to being a good cause, is because it's actually just a lot of fun. And I want to invite all of you to come join us. So among other things, the Business, Entertainment, and Law Council hosts monthly happy hours at either fun or swanky events here in Century City. Our next one coming up, I'd say qualifies as fun. On June 22nd, we'll be hosting an event at Paddle Up at the Century City Mall. There will be catering by Benny's Tacos, and it's a rooftop. So happy hour, tacos, and a rooftop. I think that checks all the boxes. We welcome you to come on out. The next one would be a swanky one. We'll be at the Circa 55 above the Beverly Hilton on the rooftop. That's July 30th. We also host what we call Coffee and Connections, where we meet at rotating venues and coffee houses where we gather to network and build community, and that is held on the second Tuesday of each month. So please come out for that. The next one will be, I'll give you the dates later. And then we have a golf tournament coming up on June 22nd in Tarzana at the Mulholland Country Club. Please come out to that if you can. And then the date will be announced for this really fun event we got coming up. I'm looking forward to it a lot. I've been calling it Hiding in Plain Sight, The Secrets of Century City. It's going to take place and or start right here in the tunnel, the secret tunnel that connects this building with the Fairmont across the street. And if you don't know about that tunnel, come on out, and there's a lot to learn. And if you do know about that tunnel already, I guarantee there's more that meets the eye, so please come on out and see what's hiding in plain sight. Turning to today's event, I want to remind everyone that we will have Q&A at the end, so please hold your questions until then so that we can answer your questions thoroughly. And now it gives me great pleasure to introduce our moderator, Gianni, Novo, Senior Vice President right here at CBRE of Debt and Structured Finance. And he knows this topic and thoroughly, so he will guide us. Please take it away.
Awesome. Nice, Travis. Thank you, Travis. Thank you to the Chamber for having us. Thanks for CBRE for hosting and opening up the office. It's going to be a great event. We've got strong panelists here that have a lot of industry insights throughout different business practices. So we're going to hope to cover a lot in a short amount of time. And I think first what we'll do is I'll introduce myself really quick and what I do, and then we'll run through each panelist and maybe spend like a minute or two, just, we'll be quick but informative about your business practice. So I run a practice here at CBRE that finances commercial real estate, size 1 to 50 million bucks, and my team works across all product types. So that includes multifamily, retail, industrial, office buildings, construction loans, you name it. And we have the privilege of working with capital partners all across the industry, and that would include banks, credit unions, debt funds, life insurance companies, CMBS lenders, you name it. So we have a pretty unique perspective on the market. We try not to forecast or speculate on what's going to happen, but we do see pretty unique trends just based on the volume and the deal flow that my team works on, and collectively at CBRE, the whole debt team works on. So that's what I do, and let's go to David.
Cool. Before we start, we're in the age of digital media, so everything's going to end up on LinkedIn eventually. So we might as well take a picture. Right? 1, 2, 3, cheese. All right, I'm going to tag every single one of you. So you'll learn a little bit more about what I do on the panel, so I'll kind of reserve time. But at a high level, just professionally, I oversee Pegasus Investments. We're a commercial real estate advisory and asset management firm. We're based here across the street, and we help primarily family offices and high net worth investors with direct real estate ownership, and that's everything from acquisition, disposition, debt and equity capitalization, asset and property management, construction project management, leasing. And so, effectively, all the services that CB offers, but cater to more of a private investor as opposed to an institutional investor. We manage about a $4 billion portfolio of real estate across 37 states. It's primarily retail, anchored, unanchored shopping centers, and single tenant net leased. And I think that's good enough for now. Rachel?
Well, it's a lot to keep up with. Rachael Sery, George Smith Partners, Managing Director and Head of Capital Markets. We really only do one thing, but I like to say we do it well, and that's debt and equity placement. I'm a product generalist, so I work across all product types. I have the pain and pleasure of doing a lot of the more esoteric financings. So I do like tax credits, EB5, corporate lines, different things like that, but really I can do anything, and I always try to tell people I can do the easy stuff too. And I'm looking forward to a conversation. Yep.
Hi, I'm Michele Piccirillo. I'm the Executive Market Director for Citizens Private Bank here in Beverly Hills. I've been in banking for over 2 decades. Some of my team members are here and former team members are also here. We're former First Republic employees, and today is actually the 3rd-year anniversary of Citizens Private Bank being formed in the wake of the First Republic failure. We've joined in about 7 months ago. We opened in the Los Angeles market. We've got offices in Beverly Hills and Manhattan Beach. We're proud members of the Century City Chamber of Commerce, and we really specialize in niche private banking, wealth management, lending services across commercial real estate, primary residence, second homes, mortgages, construction, you name it. Mostly loan sizes between 1 and 50 million. Everything kind of stays on our portfolio. We also have a robust commercial bank that would, can lend on sizes above and beyond that. So happy to be here, and thank you. Gianni a long time, so thank you for coming.
Thank you for coming.
All right, excellent. I'm Bissett. I'm a partner at Cox Castle and Nicholson, which is a real estate-focused law firm that's here in Century City, just down the street. I'm personally based in Irvine, but I was here for many years before relocating. My practice is focused on representing both borrowers and lenders in connection to any sort of commercial real estate finance transactions, anything that's secured kind of directly or indirectly by real property. I represent lenders and borrowers on all sorts of asset types and kind of do a lot of work here on the West Coast, but all over the country. We go kind of wherever the markets are, wherever the deals are. So work on originations, asset management, enforcement, the whole life cycle. So excited to be part of this panel today.
My name is Kate Bassett, excited to be here as well. I'm also very much an avid soccer fan, so it's a little bit painful to be here when the opener is going on right now with Mexico and South Africa. Yes, thank you. But no one told me the score until I have a chance to actually watch the game and review. But I'm a portfolio manager at Invesco Real Estate, so I focus primarily on our core plus bridge lending funds. Invesco Real Estate has been around for over 40 years now, and today we sit at about 80 billion of AUM across the globe, and really focused on different investing across the capital stack, risk spectrum. We do it all. We're really excited to be here today.
Okay, let's give it up for a panelist. So Kate beat me to it, but yes, it's World Cup Day. So I'm also going to do a little quick Century City hype. This is the Century City Chamber of Commerce event, so we all should know about a few things that are happening here. So 1 block from where we sit, the Metro D Purple Line in Century City station is about 83% complete. I know for us that work here, sometimes it could be an inconvenience. Constellation's closed, and they've been working on that for some time now, so that's exciting. I think the opening is spring of 2027, so that's coming up soon, and we're all pretty excited that that project will be completed.
Are we?
To be determined, I guess. And also, it's worth mentioning, so the Century City Tower, the big tower right next to us that is about complete, that's already pretty much pre-leased up. we don't need to talk about the tale of two cities. We all know about that downtown LA versus what's going on in Century City. Century City is, one of the strongest office markets in the country. I think the average rents in that building are somewhere around $750, $775, something in that ballpark. And Century City's office vacancy rate is it's about 10%. And so somebody can fact check me on that, but it's about 10%.
Does anyone know where Century City actually ranks in terms of best office markets in the country? Oh no, I know you're an expert in this.
Depends what metric you're talking about.
Just most desirable, highest occupancy, best rent growth.
Top.
Top five.
Top five.
Number one.
So that goes to say, this is still global capital flows to Century City. There's some big names that are leasing up that tower, CAA, Clear Lake Capital, Sidley Austin, so some pretty powerhouse type organizations that are going to be occupying that space. So now there's a lot of ground to cover. Let's jump into what we're all seeing in the headlines, at least in the commercial real estate finance business. The rate environment seems to be the central headwind of our business. Everybody on the panel probably talks about it daily. It influences commercial real estate investment pretty heavily. I'm going to drop some stats and then we're going to get into some opinions here. So the 10-year US Treasury, as of yesterday, closed at 4.56 versus 6 months ago, 4.08%. The 5-year Treasury, 4.28 yesterday versus 3.66 about 6 months ago. Jobs report last week came in pretty strong. If you don't know already, Kevin Warsh just succeeded Powell. His term expired May, and his first Fed meeting is next week. There's a strong call for holding interest rates steady, so and the market's not expecting that anything's going to happen next week as far as interest rate movement. So this brings me to a question for our panelists here. Is it time for investors to hedge for rates going up, not down? There's been some pretty, strong optimism amongst the investors that, we're holding out for rates to go down. But to me, it seems like maybe some protection, to the upside could be prudent. So maybe.
Yeah, I think if you can predict where interest rates are going, you shouldn't be in the real estate business. You can make a lot more money with a lot better liquidity in other types of capital markets betting. So for us, our kind of policy is, buy the best asset that you can. Our clients, we're unofficially, we're like a wealth management firm for commercial real estate investors. So our clients tend to be longer term holders. And I would say, the best way to predict sort of what your exit cap rate is going to be is what your entry cap rate is, and then build a little bit of fluff on top of that. So if anything, I would underwrite slightly less friendly interest rates on an exit, and if your numbers don't work, then they don't work, and you probably shouldn't buy the asset. But betting on cap rate compression or interest rate compression is, I think, a very dangerous game to be playing.
Yep. Rachel, your projects, if I'm not mistaken, the deal cycle timeframes span a little longer. Are your clients sensitive to what's going on, month to month with interest rates, or how do you feel about that?
Well, I think because a good amount of my deals employ some more atypical financing structures, they're less subject to 10, 15 basis points of movement in the index, and we've seen spreads holistically coming in the last year or two. So I'd say maybe a little bit less sensitive than some of the institutions that kind of just do the copy and paste on a lot of acquisitions. However, that answers your question. Yeah. I would say just with respect to the volatility of the market and where the future is, that one thing that I think is important to kind of look at is, our founder used to always say, if the shoe almost fits, wear it. None of us have any idea what the market is going to have going in the future. We have inflation, but we also have tremendous wealth creation and GDP growth. And so I think if you could do a deal today with something that's in front of you, you should do it.
So from my perspective, the levers that we typically advise and that we can play with our clients are generally We're looking for prepayment penalty flexibility to be able to capitalize in the event that interest rates do compress. Interest rate buy downs, shorter terms, if you're playing the market, shorter fixed terms. We're also negotiating lower floors, especially on floating rate debt. So those are some things that we're doing. IO as well. Michele, on the banking side, these are all probably common things. I know you're working a lot on commercial financing requests. Did I miss anything? Is there anything else that you're seeing your clients ask for?
Yeah, one particular request that came up the other day that I thought was really interesting was we were able to offer a client, he only had about $1 million for debt on an apartment building, but he had owned it for a very long time, and so it was worth like $8 million, and the building cash flowed for, I don't know, let's call it $4 million. So he didn't really want the money to be pulled out of the building, but he also wanted to have the money opportunistically in the event that, everybody thinks that, the market's going to crash and they're going to be able to buy their new dream properties. So what we were able to do is size the deal to a $4 million loan, offer the first 2 years of interest only. He structured it so he took $1.4 million out at close, and then he had on an interest only payment basis, and then he has the opportunities to take additional draws for the next 24 months. At the end of 24 months, it converts into a fully amortizing 5-year fixed, which would balloon at the end of that term. So that was something like really, really, really creative that we came up with to try to assist. We're also starting to put commercial debt on investment, commercial debt. Is that better? It's not on. Is that better? Yeah. Okay. Also starting to put some commercial debt across single-family investor portfolios, which has been an interesting play. But yeah, lots of requests for interest only, lots of requests for maybe not max proceeds, but how do I keep getting capital on my property? Not a lot of requests for long-term debt. I haven't quoted out anything longer than 5 or maybe 7 years in a very long time.
Casey, when you're working with sponsors on negotiating loan docs, are there certain points or deal structures that you find yourself commonly negotiating?
Absolutely. I mean, as it relates to interest rates in particular, as you said, prepayment is a hot button, and how long you're locked out for, what those penalties look like, what the minimum interest is, how it all gets calculated is definitely much discussed. And then for a lot of floating rate deals, rate caps. We have a lot of discussions about what those rate caps look like. What's the term? Do you need to have a cap that covers the whole interest or the whole initial period, or can you do string together 1-year caps? Are you having the notional amount increase or decrease, or over time or all up front? So those kind of structuring around your hedging instruments become really important and discussed a lot more than they used to be in recent years.
I have a question. So what are borrowers giving up, if anything, for this prepayment flexibility? Because it's not free, right? I would imagine. Right. Lenders want to have money out. They want to be managing their assets and liabilities and projections. And when a borrower can just prepay at any time, that's problematic. So something has to give. Like, what's being given up?
It depends on the lender and kind of how they're structuring their deals. Sometimes the lockout period where it's just you cannot do it is shorter, but the yield maintenance period is longer. So it's a more manageable premium. So you have some flexibility, but it costs you money, and you have to deal with that longer before you actually hit a prepayment at par. And then sometimes it'll show up in an exit fee or in an increased commitment fee. So the economics will get where they need to be, and unless you have a great asset where you've got a lot of lenders competing for it, and to your point, you want to have the best asset, because even if there is rate risk, or you can use these negotiating tools to get those down. But that's kind of where I'm seeing it.
I'd echo what Casey just said in terms of the commitment fee, right? So what we have been seeing in terms of short-term bridge loans is we have been seeing that average commitment fee up front be closer to 1% in early 2025, but that has since moved down. So you're seeing anywhere from like 75 bips to 85 bips, right? So one of our tools right now is if there is negotiation around prepayment we'll increase back that commitment fee upfront.
Yeah, and I can say on the lender side, you're generally, especially for loans less than, call it 20 million bucks, you're definitely going to pay for prepayment flexibility in the terms of the interest rate, all-in coupon. Sometimes it's as easy as adding on, to a rate to compensate for that prepayment penalty flexibility. So it's a very common theme
And you're saying,
in our business practice.
that borrowers are willing, they're more often than not, they're willing to pay a thicker spread in order to get that flexibility?
Yes.
Okay.
Yeah. Kate, I have another question for you because on the capital provider side, how do you guys think about this volatility in the 10-year yield, or do you guys price off of SOFR? SOFR's been pretty consistent for a long time now at 360 something. So how do you think about that from the capital perspective?
Yeah, great question. So again, short-term bridge loaners, we're also relationship lenders at this point too. So really where our focus has primarily been is even as we've seen some of this increase in 10-year treasury, things like that, I think our biggest focus has been more on SOFR, but also where the general market and meeting the general market is going to be. I think one interesting thing that we probably didn't touch on as a group too is just this wider trend of more of a focus on income generating assets, right? Because back to debt isn't as cheap as it once was. People are really starting with income front of mind. And you see this even as we've seen refinances increase year over year in the last quarter, right? So refinances are up 30% year over year. And a lot of this, the biggest screening tool for a lot of it has been debt yield. And where can you get that increased debt yield at this point in time?
Okay, good. So the next theme I want to move.
Point something out real quick. I don't know which side of the fence I fall on, but I think it needs to be pointed out, is that you can say since the onset of the second Trump administration, and this is a completely apolitical statement, by the way, that we've almost become accustomed to these crazy market volatility movements. And I think it could be a good thing and it could be a bad thing, right? Because when you see the market trading off significantly, you're not acting on that necessarily. You're not panicking. You're saying, okay, well, Trump just shot off a tweet about, wanting to attack some Middle Eastern country, and then, a couple days later, he'll rescind the tweet, and then the market will shoot back up to even higher highs. And so I'm not gonna react like within the headlines. And I think that that's actually a very good thing for market stability, because this knee-jerk reaction that I think a lot of us have grown up with in our careers is somewhat being leveled out now. The problem with that is that this numbness also doesn't allow you to feel real things, right? And so when you should be reacting and you don't, you could end up getting yourself into situations that you otherwise may have not gotten into or aren't so exacerbated. So I don't have any answers. I think it's interesting to just point out the fact that we're not seeing equity and debt react with CNBC. They're just not.
Yeah, good point. Okay, so let's talk about the maturity wall. This has been thrown out there for the past few years, I think since 2022 or 2023. And let's put that in terms of numbers. So the Mortgage Banking Association has maturities in 2025 was pegged at $957 billion. 2026, $875 billion predicted this year. And in 2027, it drops a little bit to $652 billion. Some of the headlines say a lot of that distress is concentrated in office and new delivered multifamily per some TREP delinquency reports that were recently published. In 2023, I saw this pretty clearly. It seemed like the industry was mobilizing to address this maturity wall. And from my perspective, that's one of the catalysts that spurred all the private credit and debt funds just to pop out of nowhere. Every CMBS lender, every private credit fund, everybody wanted to chase yield in commercial real estate this way. So I'll start with Kate. Did this wall at Invesco materialize? And I think you guys created special funds to address this, right?
Yeah, great question. I'm really excited we're done. We're close to retiring extend and pretend at this point. So I know I just used it, but I'm glad you didn't at this point. But no, I think when we were going into this time period, we had seen real estate market and valuations reset significantly, right? I think as a real estate lender coming into a market like that, we really saw an opportunity, right? So there's this wall of maturity, there's folks looking for refinancing who might be in a little bit of a squeeze at that point in time, looking for different options and short-term options as well. But we get to do it now on reset property values. So getting our pick of best-in-class real estate, doing it with best sponsorships too, but now doing it at this reset basis. So that was definitely the opportunity that we saw from a debt side, but also seeing it from the equity side as well, right? So some of this wave and where you're seeing what's going on with multifamily too, that's potentially an opportunity for equity acquisitions as well during this time. So again, where some people see risk looming over the forefront, we really saw a market opportunity at Invesco.
Yeah, and I feel like the grace on the lending side is now starting to exhaust and expire itself. Now it's either sell, refinance, recapitalize, or bring fresh equity to your deal. And it seems like it's about time. Michele, on the banking side, are you seeing some of your sponsors, your borrowers, bring in new equity to bridge the gap on deals that they want to keep in their portfolios?
Interestingly, yes, but what they're doing is they're going to, these debt funds that have popped up that will, lend at a much higher yield. So some of them are saying, I don't care how much lower your rate is. I don't want to put more money in the deal. Interestingly, I saw for the first time in a very long time last week, I have a buyer buying a short sale on an apartment building in Koreatown. That just shows you, rents aren't where they used to be. So the trend is definitely different. But I think you're right. Pretend and extend is finally over.
And David, from an asset management perspective, a lot of your investors, are you seeing any challenges with your portfolio and some of your clientele on, does this still exist, or are we kind of, at the latter stages of this extend and, pretend and figure it out later cycles?
Yeah, so, the profile of the portfolio that we manage is primarily retail, and it's high quality retail in strong markets. And retail is having its day. Across, it's about 400 properties. We're at like 97.8, almost 98% occupancy across the portfolio, which is sad.
And that's all across the country?
It's 37 states. Yeah, it's 37 states. The construct of many of our clientele are, Southern California investors that have, over the last 15 years, repatriated capital outside of Southern California into other growth markets. So, Phoenix, Salt Lake City, Austin, Dallas, San Antonio, Nashville, Huntsville, Tampa, Orlando, all of South Florida, the Carolinas, Atlanta, and then even into the Midwest, Kansas City, Columbus, Ohio. I woke up at 4 a.m. in Des Moines, Iowa this morning, which is a phenomenal market, by the way. So, what's happened is that initially that wave started as just a purely economically driven opportunity, right? Things have historically been very pricey and expensive here in Los Angeles and Southern California. And when you have, these family offices that have, that are sitting on significant equity capital, and with the multi-generational transfer of wealth that's happened and will continue to happen probably for the next 15 or 20 years, I forget who it was that said about cash flow and income. Was it you? It was you. Okay. That has been the focus of many of our investors. They made extraordinary appreciation, and they kind of want to reposition the portfolio to less, kind of less risk. They still want appreciation, but they want strong in-place cash flow. And they're all spoiled from being in Southern California for decades, and so they don't want to go and move it into a market in the middle of nowhere where they're not going to get any appreciation, because they know what a death trap that could be. If you leave capital in a flat market for 20 years, you're going to miss out on total return. But what we've seen really is in the last 5 years, the shift has been less economic driven and more get me out of California driven, right? And I think that's something that's a very important topic. That we should talk about is the political pressures that commercial real estate owners, high net worth, family office, and definitely institutional, have been feeling in California. And quite candidly, people don't understand. It was a CBRE report that came out about a year ago, and published, but I'm sure you guys do it monthly, where you track all the 1031 exchange investors in the country, right? If any of you guys have ever gone to a CBRE to download the OM, aside from giving them all your information, your DNA sequencing, your social security number, the one thing they want to ask you is, are you in a 1031 exchange, yes or no?
Someone's need to pay this rent.
By the way, it's a beautiful office, so it's working out, it's paying off. So you guys track this information and then plot it out geographically of where are these 1031 exchange buyers based and where is that capital going. And you should not fool yourself. The growth in all of those markets that I just mentioned from a commercial real estate standpoint, a lot of it is being fueled from California. We're the 4th largest economy on the planet, and there's a tremendous amount of money that is here, that has been created here, but that has also left. And I think, as far as, the tale of two cities, right? It's not just, are you downtown LA or are you in Century City? But it's also like, are you in Florida or are you anywhere else, right? Are you in a state that is very progressive from an economic policy perspective, pro-business, or are you repressive, right?
I want to jump back into that. That's a really important topic. Before we do that, I want to jump to Rachael. So at GSP, they work on traditionally very highly structured types of deals. What are you guys doing, or what are you guys seeing in the capital stack to address the deals that are maturing and maybe the economics aren't just quite there for traditional refinances?
Well, I think that a lot of the lenders that historically did kind of high octane debt before things turned, a lot of those loans are still in distress and there's not really much to do on them. I mean, you see like huge portfolios that are owned by large institutions or SASB deals, and like without major losses, they're not really solvable, and I don't know if that's going to necessarily change in the near term. I would say, like, we have people who are doing workouts on behalf of clients, and it's sort of approaching the point where they've taken enough quarterly write-offs that they could eventually transact at a number that has more alignment with the current market value. And that was kind of the play when like interest rates and values shifted a few years ago. It was like you saw the Odyssey index funds had like huge losses, but their books didn't show any of it, and they'd start hitting them at like 8% a quarter or whatever. Well, come to today, some of those have parity now. And so I think as that occurs more commonly, we'll see more transactions throughout the equity side. But in the interim, like, we get some clients who are willing to give the keys back. I mean, that's a pretty common thing. And so then the debt funds or the private credit, they become our client, right? We're doing a lot of DPOs and a lot of note sales and a lot of creative structures where maybe a client's buying their asset back without their equity partners in an unrelated entity. I mean, like, we see all kinds of things in this market where people are getting creative, trying to hold on to the things that they've been fighting for the last decade that just don't make sense at those bases anymore.
Interesting. Casey, is there an uptick on the lender side, the lender representation side, in workouts or seeing this distress filter down to the legal side?
Yeah, absolutely. I think in the past 2 years, the properties like the office properties and the B markets, those have kind of worked their way through, where there was no obvious kind of path forward, keys have been handed back, those workouts have happened, foreclosures have happened, basis reset, and now they're back in the market at a more logical basis and on a path that can succeed going forward. I think now the next wave we're seeing are properties that were more on the edge and we're waiting for rates to come down because maybe there was a chance that they could hold on to it, but now it's becoming clear like it's nothing material is going to change and make their business plan work. So we are seeing kind of another wave of deeds in lieu or their short extensions because they're refinancing or selling or doing something to accept the losses, kind of cut their losses and move on. So it's definitely I think we're kind of we're in the second phase of that.
Yeah, and it feels like we have prospective clients that come to us, but they're a little too late.
Yeah.
They should have come to us 6-9 months ago to find solutions or structured solutions to help them out of these situations that they're in.
How far in advance do you recommend before maturity?
I mean,
Depends
you've got
on how complicated your asset is. If you've got a good story to tell.
It depends how bad the economics
exactly.
are on the deal. But you've got to be at least 12 months ahead of it. It takes that long to find a solution, if there's even a solution out there. But to Rachel's point, sometimes it's just a write down, or a deed in lieu or a give back.
So I realize I went on a rant off topic, but to answer your question, okay, sorry. I've got a little bit of an axe to grind with what's been going on in my beautiful Southern California that I've lived in for 44 years. But to answer your question, we did a lot of originations in 2025 and 2026, 10-year fixed rate IO, right? These are, you're buying good assets at a 6 cap and financing them at a sub 4, interest only, and you're puking cash flow on A quality assets, right? So a lot of our clients have said, okay, well, the last 10 years has sort of been an anomaly, right? And maybe the next 5 years are going to be a little bit of an anomaly, but if I'm looking at this thing over a 15 or 20 year cycle, I'm kind of good. And so ultimately, it all depends and it all comes down to whether they like the asset or not. Mm-hmm. Ultimately, they're asking themselves, do I love this asset or do I not love this asset? If they love the asset, they're dumping equity back into it if they have to, or they're refinancing and crushing their cash flow, but they're holding on to it. If they're like, this asset kind of sucks, then they're dumping it, they're getting rid of it.
I think to that point, the volatility we're experiencing in the market, if somebody is really like making a deal work or not work by 30 basis points, they're missing the alpha on their strategy, right? I mean, you kind of need to have a contrarian play in order to have any profit in this market. And in that case, you're not really as rate sensitive as the indexes have been moving, on any short-term basis.
It's back to the earlier market comments too. So what's happening today is like the real estate market isn't paralyzed, right? It's being filtered in a lot of ways. So to these earlier points, really what's happening is there's transaction activity is increasing, there's debt availability, but really conviction right now is narrowed, right? So really focused on where they can find value.
Yeah, and just yesterday I was speaking with a developer on analyzing a few construction projects, and we did this, the complex underwriting and projections of this construction model. And at the end of the day, we just took a step back and said, hey, look, you've got to have an edge in this market. Whether that edge is your land basis, is that edge your cost to build needs to be substantially lower. There's got to be something to propel a project to move forward. So that seems to be a common theme, and that seems to be why, nothing is really, the economics on construction deals right now are just not really making much sense, which could be a little different, Rachel, I'm sure, in some different markets. But as long as, in LA, it's really tough to get something off the ground.
Which, by the way, there's a yin to every yang. So like, for example, retail, right, is a good example. You can't build new retail. It's too expensive. Land's too expensive, construction costs are too expensive, capital's too expensive. The rents that you have to back into to get a return on cost that pencils, the tenants can't pay. So what happens? There's no new supply that comes online. And so you have this fundamental swell from the ground up, which is where it should come from instead of the top down. You don't have to financially engineer the fundamentals anymore. The fundamentals are just there. And so I think like at the end of the day, the capital is going to change. It's going to blow in and out with the wind. But like that's why I think it's so important for everyone to focus on fundamentals at the asset level, asset and market level fundamentals. Will save you through any capital event for the most part.
Well, and I would say it's market levels, almost above, because you're looking at supply and demand. The only development that's getting done is where there's no competing supply. You have the distress that really only further exacerbates the dynamic where why would equity go take the risks to build when you could buy for 30, 40 cents on the dollar the exact same asset? Like, there's not going to be any equity interest when you're buying below replacement cost in a distressed market. So
Yeah, well
that's
said.
also a thing below, like replacement cost. Like that's another extend and pretend term that maybe like everything's below replacement cost now, ladies and gentlemen. Okay, like if you could buy something below replacement cost, it doesn't mean you're getting a good deal. Okay.
Touche. All right, I want to be mindful of time. I want to move on to another topic. And this is a pretty simple one. So where is liquidity coming from? What's keeping our CRE markets liquid? There are a lot of stats that say, banks are taking a step back and in replacement debt funds are really starting to take over. From my perspective, I can tell you, so CBRE is also a direct multifamily agency Fannie and Freddie lender. If I look on our national pipeline, we're seeing stabilized multifamily agency deals still getting signed up at 5-handle interest rates, which is fantastic. But Michele, that step back, that retrenchment, I'll say, from the bank. Sorry, the narrative about bank retrenchment is that. How do you feel about that? I mean, you're on the front lines. You're a bank.
Yep.
I know you're a private bank. Often you want deposits, and you can be very accommodative on terms with deposits.
Right.
So, what do you think about that?
I think that's spot on, Gianni. I mean, when you lost First Republic, you know, particularly in California, you lost a big player in the market, and debt funds have stepped in, small community banks have stepped in. There's only so much capital. I think, JP Morgan does very well in this space, and they're always going to have capital, right? They're an enormous bank, but it's got to be a very kind of cookie cutter transaction. So where we're really filling the void is exactly what you just said. Clients who want to bring deposits to the bank, sign with personal guarantees. We're gonna, not give us any of these problems later for any of these people to work out.
Is getting deposits? I mean, getting deposits is still challenging, right? I mean,
Yes and no. I mean, when you're up against that wall and you have to refinance, and your incumbent bank isn't willing to accommodate you, and we are, and we're giving you a phenomenal rate, and we're waiving your prepay after a year if rates come down, and we're giving you terms that are upper fives that are fantastic. It's painful to move your banking. Like, everybody knows this. It was painful for me to move my banking.
She wants me to sign loan docs on. I'm playing the interest rate market, so I'm sorry. Give me another week or two.
Raise your hand if you were a First Republic client that are now a Chase client and are very upset about it. That gives you an idea of how hard it is to move your banking.
It is, but that's our job, right? We're here to make it easy for you. We're doing the best we can. Gianni slowly but surely will be with me by the end of the year. But it's going to come to a point. We were really so busy in 2020, 2021, 2022. 2023, we're kind of, this is getting a little challenging. 2024, everybody's saying, you remember the quote, survive until 25, right? Then it became survive through 25. Now here we are in 26. I mean, at some point, this may just be the new normal, and people are going to have to, they're going to have to.
We thought it was get rich in 2026, but it's not working out well.
Your lips to God's ears.
So I want to segue that into, I want to agree with you, David. Being a principal isn't easy, right? Being a principal in Los Angeles, specifically isn't easy. You've got local regulations, cap rates are widening, cost of capital, is volatile, it continues to go up. Operating and labor costs are squeezing NOI. So I agree with you, and that's why we've got a lot of capital that's flowing out, especially to retail, to that benefit. Kate, this is interesting. Is private credit the new way to keep real estate exposure, maybe on the institutional investment side, and earn higher yields without the brain damage of being an operator? And, is capital flowing on the investment side, on the capital raising side?
Really good question. So I might actually change that a bit. So you mentioned institutional.
It was so good, she wants to change it.
I'll tweak slightly. Where we've actually been seeing a lot of capital inflows recently has been more on the retail side. So private wealth side specifically has been coming more and more into real estate credit. You're seeing the launch of, again, we talk about new competitors in the debt fund space. A lot of those are releases of these non-traded REITs that are coming to market too, really specifically targeting those private wealth and retail clients. And look, I think it's a couple of things, right? A lot of groups are looking for income during this time, so we already talked about how that's a benefit. I think there's a lot of groups that are looking to reposition allocations amidst direct lending headlines, right? So we hear a lot about what's going on with the BDCs. So you're seeing some inflows related to that, where really they're trying to get the income, but also get asset-backed exposure, right? That's been the name of the game. So really where we've seen a ton of progress in fundraising has really been through those channels, specifically where they get the benefit of the income, but now it's asset secured financing.
And I know we got some financial advisors out in the crowd, so that might resonate. Maybe some of their clients want the exposure of real estate.
And very little correlation. If you look over like the past 10 years, very little correlation to direct lending specifically, but I would say closer to like 0.05, 0.06 correlation to real estate equity as well. So good diversifier for portfolios.
Interesting. And a fun fact that, through my research I looked up, commercial real estate debt is the 4th largest fixed income asset class, which is very interesting, behind corporate bonds, U.S. mortgage-backed securities, and treasuries. And then munis are actually 5th.
6 trillion. And it's actually 8 trillion globally.
Wow. Okay.
Which is almost the value of Elon Musk's company. Just to put it in perspective, it's not that big.
Before we go off of the banking thing, just to, you talk about banks kind of coming out of the space, but we see them coming in so much in the secondary market of the lending side of things, behind these private debt shops and other lenders where they're going to making the loan, the debt fund is out there, but they're on the back end, they have their warehouse facility, their repo facility, and those are all the major banks, right? So the banks are still very much involved in real estate and in real estate lending, but it's one step removed. It's a slightly more conservative position, but just something to keep in mind. Your lenders out there, not just, they might have kept everything on their portfolio or on their books before, and they probably still are, but it's subject likely to also a line or someone from the bank, another bank out there, because that's where a lot of this liquidity is coming from for these non-traditional bank lenders.
Okay, great. Okay, we're nearing the end, so I want to wrap it up shortly here so we can open it up to Q&A. But before we do that, I can't end this without talking about AI. Let's keep this quick and tight. Can we go down the line here and give me one real example of how you use AI to enhance your business practice? Or is it just overhyped in your business practice? Let me know.
No, so where we see it as an organization for Invesco is it's really the focus on efficiency and speed at this point. So take it from the perspective of an underwriter, right? Where we see AI plugging in is really giving their Mondays back in some ways. We're automizing 60% of the process where it's more data entry, things like that, but you're still keeping the 40% that's still decision-making and judgment that we need. But really we see the benefit of just bringing speed to market when you're evaluating deals on the lending side.
Casey?
Yeah, I'd say similar. So being a law firm, we have a lot of constraints around what we can and can't do, but in diligence digestion, right? So looking through all the information that's on title or, a series of similar agreements, getting that baseline factual diligence digested and summarized much more quickly, and then you can do kind of that second step analysis and problem solving on top of it has been very helpful.
Michele, you guys are heavily regulated, I'm sure. You guys allowed to use AI?
We are allowed to use AI. We use Microsoft Copilot, part of our Microsoft suite, and we are heavily encouraged to do so. Just to streamline exactly what these ladies just said, just to streamline effectiveness. I can't imagine not having AI in my job now. Really just helping us, like I'll drop our guidelines in there and say, tell me one very specific nuance instead of like looking through the whole, PDF. So I've got a little bit of AI fatigue, but I also can't imagine not having it.
I think that kind of GSP 2.0, since being acquired by Access 4 years ago, has become a very tech-forward company. And so, even as a boutique firm, we spend millions of dollars a year on AI products and integration. We see it all throughout. I'm really jealous personally that when I was an analyst, they didn't have this. I can't tell you how many nights I was up until 2 a.m. formatting a PowerPoint. My goodness, I could have saved myself some real time. I could have had a life back then, or at least gotten ahead faster, I don't know. But we bought a prop tech company recently that does a full A to Z underwriting of deals, which we now offer as a kind of free calling card for all of our clients. And we've literally had like large institutions send us like entire portfolios of stuff and be like, well, this is a great opportunity to just have like an outsourced team pretty much for free. It's a huge advantage, not just for, internal purposes, but things you can offer your clients if they're leaner shops or if they want to run leaner P&Ls. It just takes away a lot of the manpower.
Yeah, so I think one thing that people aren't really talking about is the sequencing of COVID and this work from home awful situation that a lot of people got themselves into with AI right behind it. So we're a work from work company. We have 2 work from home days a week. It's Saturday and Sunday. Otherwise, you're in the office. Our people are not only safe from AI, but they're actually being elevated as a result of AI, right? Because they're not viewed as already outsourced, where they can be replaced with a technology that is outsourcing. So I think what we're all realizing in real time is that AI is a phenomenal factory worker, but they are terrible at judgment, okay? And the only way that you learn judgment is by being in an office and learning from people who have learned from their mistakes, okay? So I think it's going to be a very interesting case study for those who have been remote working for the last 5 years and now have to contend with AI as a competitor versus those who have been in the office and are going to be able to leverage this unbelievable technology. The last thing I'll say about this is for us specifically, we're very forward thinking in terms of this. We announced a joint venture with a company called 4 Enterprises in the Real Deal a couple weeks ago. So we're in it for sure. Partially because it's really cool and interesting, but also partially it's an insurance policy. Like we're covering our assets, right? It's like we don't want to be left in the dust. It's part of like, it's like the whole like, oh, are you, like with the, all the, whatever it was, what's the type of investing that we all used to do, if it's like green investing or whatever it is, like every institution has like the logo of like, oh, like we're ecologically
LEED certified. LEED certified.
ESG, right? ESG. So like, we just put the AI thing on our website just the same way that, others used to put ESG on their website, right? We just don't want our competitors saying, well, the Pegasus, they're dinosaurs, they're not using AI. So it's still very early, we'll see where it goes, but no, it's a very exciting thing, and then the specifics are absolutely on the intake side, just digesting exorbitant amounts of diligence and categorizing it and filing and all that sort of stuff, but also our ability to be able to answer our clients' requests quickly in a very compelling, professionally formatted presentation without us having to go through and tie up our entire marketing team just to get a sort of simple but still needs to look good type of presentation out, whether it's a pitch, whether it's a portfolio review, anything like that. It's unbelievable what you can do through AI without having to, you know, burden your in-house marketing team or outsource marketing team for that matter.
Thank you guys. And I'll second all of those comments that you guys made. CBRE also staying on the cutting edge of AI, especially when it comes to data, just because we're such a large organization across the country, and we're working to come up with better ways of monetizing our data. So more to come on that. Let me close out, and then we're going to go to Q&A. We're just going to keep this really quick. This is fun. All right, you guys pick one. How far does Team USA go in the tournament? Remember, there's 6 rounds. What round? Or you can give the room a piece of advice. You pick. Kate.
Team USA will definitely make it out of group stage, in my opinion. I'm unsure past that. We'll see. I'm hopeful. I'm
Very
optimistic.
diplomatic. Casey?
I'm gonna vote for round 3 because I want to see some. Okay. Stay optimistic.
I'm going to say Team USA goes all the way. America needs to come back.
My piece of advice would be never listen to me about anything with sports because I have no idea what I'm talking about. So I'm not even going to try to answer that question.
I have 2 left feet, and so I don't like playing soccer and I don't like watching it. I'm just still in shock over the Knicks game next.
Oh. Okay, I'm going to say round 3. Okay, everybody, thank you very much for your patience and listening to all the lovely panelists here. We're going to open it up to Q&A for a few minutes. If anybody has a question for anybody up here, just let us know. I can also pass the mic to you.
I'll go. Hi, Trevor Hopper, Corporate Contractors. Question for David. For the whole panel that you addressed retail, are you working on any initiatives or programs to help existing space instead of actually ground up so that we can improve what we have? You look at Topanga, right? We ripped down the whole entire mall with the standard concrete building across the street. Is there any programs that we're looking at to help existing space?
Are you talking about specifically our Topanga project?
Not just Topanga, but any retail.
Okay.
Yeah.
Yeah, I mean, look, consumers are so much more picky now than they've ever been, right? Because social media, basically everyone's living like their fake best life online. And so, it's like, oh, hey, I want to go to a restaurant that looks like that, or I want to go shop at a clothing store that looks like that. And so everything's sort of being pushed up. There's a lot of pressure on retailers and on landlords to have like very, very good-looking, very chic type of retail experiences, and that's all the way up and down the board. So the answer is yes, absolutely, and it's expensive. And the landlords are funding a lot of that, and it's finding its way back into rents. The tenants are also taking on their fair share of the burden too. So you should be busy.
Trying to be.
Anybody else?
Stumped that.
Wow. All right, well, thank you everybody for coming.